All right, let's talk about one of the biggest questions in investing. It's a real dilemma. You get a big chunk of money, so do you just rip the Band-Aid off and invest it all at once, or do you ease into the market bit by bit? This is the classic showdown, lump sum versus dollar cost averaging.
And let's not make this some abstract theory. No, let's make it real. Imagine $100,000 lands in your bank account tomorrow. Maybe it's from a bonus, an inheritance, whatever. You know you should invest it, but you look at the market and you get nervous. So what's the play? Go all in now or take it slow? The choice you make could be worth thousands.
Before you answer that, I want you to just stare at this number for a second. 66%. What if I told you that this one number pretty much settles the debate, at least from a purely mathematical point of view?
Yep, that's what it is. A huge study from Vanguard looked back at decades of market data and found that 2/3 of the time, investing all your money in one go just flat out wins. It beats slowly dripping it in. And here's the thing that's so fascinating. This data flies directly in the face of what feels right to most of us.
So let's kick things off by really digging into this 66% rule. We're going to look at why the cold hard data says going all in is usually the way to go.
And that naturally leads us to the next big question. Why does it win so often? What's the hidden math that gives lump sum investing its edge? Let's unpack it.
The secret villain of this story, the thing that holds the slow and steady approach back, is something called cash drag. See, while you're carefully investing bit by bit, a big pile of your cash is just sitting on the sidelines. It's not working for you. And worse, it's losing purchasing power to inflation, and it's missing out on the market's general tendency, which, over the long haul, is to go up.
And this right here perfectly sums up the two philosophies. Investing a lump sum is all about maximizing your time in the market, getting every dollar working for you for as long as possible. Dollar cost averaging, on the other hand, well, it's a form of timing the market. You're basically making a bet that the market will be cheaper in the future than it is today. And that's a tough bet to win consistently.
And get this, it's not just a US thing, not by a long shot. That Vanguard study looked at markets all over the world. In the UK, lump sum won 68% of the time. And in Australia, a staggering 70% of the time. The trend is global and it is powerful.
Okay, so at this point, you might be thinking, well, the math is pretty obvious. Case closed, right? So why on earth is this even a debate? Well, the answer has nothing to do with numbers and everything to do with what's going on inside our own heads.
It all comes down to a super powerful quirk in our brains called loss aversion. Study after study has shown that the pain of losing money feels about twice as bad as the pleasure of gaining the exact same amount. So the thought of investing that whole $100,000 and watching it drop to $98,000 the next day, for most people, that's just a gut-wrenching, terrifying feeling.
And that's why this quote is so spot on. Dollar cost averaging, or DCA, is an emotional painkiller. It's a strategy designed to help you sleep at night. If the market goes up, hey, you're glad you got some money in. If it goes down, you're relieved you still have cash to buy in at a lower price. It's a win-win for your feelings, even if it's not a win for your wallet.
This brings us to a better way to look at this whole thing. It's not about what's right or wrong. It's about what you're trying to optimize. Are you a robot trying to squeeze out every last drop of potential return based on the math? Or are you a human trying to find a strategy you can actually stick with when things get scary?
Now, let's be fair. Winning 66% of the time also means losing 34% of the time. And 1/3 is not nothing. So we have to talk about that other 34%, the times when being cautious was, without a doubt, the right move.
Let's hop in a time machine. Imagine you got that $100,000 in March of 2000. You're feeling great. You're at the absolute peak of the dot-com bubble. If you had gone all in right then, oh boy, it would have been a disaster.
Just look at these numbers. They are absolutely brutal. According to Morningstar's analysis of that period, a lump sum investment would have lost almost 14% a year. But the DCA approach? It still lost money, but only less than 2%. In that kind of worst-case scenario, DCA wasn't just a painkiller, it was a lifesaver.
What DCA protects you from is something finance pros call sequence of returns risk. It's a fancy term for being spectacularly unlucky, investing all your money right before a massive crash. By spreading out your purchases, DCA ensures you never buy everything at the absolute worst possible moment. It's insurance against financial catastrophe.
Okay, so we've looked at the math, we've looked at the psychology, we've looked at the best and worst case scenarios. So what do you do? How do you turn all of this into a plan you can actually use?
Honestly, this might be the most important single piece of advice in all of investing. The perfect strategy on paper is completely useless if you're going to bail on it the second the market drops. The best plan is the one that you, personally, have the guts to see through to the end. So if you're going with the robot approach, the rules are simple, but man, are they tough. Step 1, invest it all now. Step 2, and this is the really hard part, don't look. Seriously, delete the app off your phone, set a calendar reminder for 6 months from now. You have to trust the long-term data and ignore the short-term noise.
And if you're going the DCA route, you have to be disciplined. You need a contract with yourself. Decide how much, how often. Say $10,000 a month for 10 months. Then you automate it, set it, and forget it. And try to keep the whole process under a year, because the longer you wait, the more that cash drag is going to cost you.
But, of course, there is a third option. What if you're just totally stuck? Consider the hybrid approach. Put half in now, get some skin in the game, then DCA the other half over the next 6 months. It splits the difference. It's a fantastic way to break that feeling of being frozen by indecision.
So it all comes back to this simple framework. Are you the robot who's going to choose the path with the best odds of the highest return? Or are you the human who's going to choose the path that they know deep down they won't abandon when the panic sets in?
And that really is the final question. You have to be brutally honest with yourself. Are you a robot or are you a human? Can you really handle watching your life savings drop 20% right after you invest it? Or would that make you sick to the stomach and cause you to sell at the absolute bottom? Only you know the answer.
And listen, there is absolutely no shame in being human. None. The only real mistake here, the only real failure, is letting fear win. It's letting that money sit in a savings account for years, getting eaten alive by inflation. So pick a plan, robot, human, or hybrid, and just do it. The worst choice is making no choice at all.